Hey, what's next with money? Did you ever wish you knew the future so you could have picked the right stocks and investments that over time just shot the lights out? Well, in this video, we're going to show you a way to think about that. Welcome back. Coming up on today's program, How to Invest in What You Know, Part 2. Did you ever think that great investing ideas and businesses are growing near you or right under your feet? All to create wealth and grow your investment portfolio? Think of where you live, where great companies, old and new, receive inordinate amounts of local press and media. And here are a few examples. Seattle, Microsoft, Amazon, Starbucks. What a place to live. Portland, Nike. San Diego, Qualcomm. Cincinnati, my home area near Northern Kentucky, Procter & Gamble. Atlanta, Home Depot, UPS, Coca-Cola. San Jose, Silicon Valley area, Apple, really in Cupertino, and Cisco. Omaha, Berkshire Hathaway. Austin, Dell, Whole Foods, but wait, acquired by Amazon. And now Tesla just moved there. Minneapolis, Target. Arkansas, Walmart. And in my home state of Kentucky, Louisville, Yum Brands and Humana. Welcome to What's Next with Money, a program that holds the promise of second chances, strategies for growth, and financial empowerment with smart insights to guide your financial decisions. Let's get started. Peter Lynch, the retired and famous portfolio manager of Fidelity's Magellan Fund, had many of his ideas can best be seen in this best-selling book, One Up on Wall Street. And in the book, he talks about 6 categories of stocks, and this will help compartmentalize and add a little construct to how you can find investments that you know about and appreciate. Number 1, slow growers. These are companies in mature industries, and they often pay dividends. Number 2, the stalwarts. This is kind of in between the slow growers and the fast growers, but often they can be large companies like McDonald's, maybe a 10% growth rate or a little higher. And then number 3, the fast growers, the 20 to 25% growth rates. Hey, they're in an expansion mode. They are growing and developing and capturing market share and territory. Number 4, turnarounds. These are companies might be having a few problems. They might be selling off divisions, they're restructuring, they need to lower debt, or there's been a negative event that they can correct, and hopefully they can do it successfully. Number 5, cyclicals. Now these are companies that profit from a rising business cycle, where the purchases, yes, they could be postponed in a downturn, but they can capture the growth in the upswing of as the growth rates happen in our economy. And number 6, asset plays. These are companies where the stock price might be depressed and because it may not reflect all the value and the ownership assets of the company, such as real estate, subscriptions, intellectual property. And Lynch says in his book that many of these companies can be in more than one of the 6 categories at the same time. And you talk about something that really mixed things up. Just think about how the pandemic has thrown these categories for a loop, with even the rise of so-called pandemic stocks like Clorox, Peloton, and Zoom. Another big concept Lynch introduces us to is the fun notion of 10 baggers. And these are stocks and whose prices can go up 10 times from its initial purchase price. Investing in what you know and holding on, according to Lynch, opens these 10-bagger possibilities up because you're seeing the movement of these companies and understanding them because you're investing in what you know before the big folks on Wall Street see them. And you may have the capability and the fortitude to stick with that ownership when Wall Street sours on them because you're a long-term thinker, investor, and you can wait out for a turnaround. Having a few 10-baggers in your investing life can make a huge financial difference for your net worth. So here are 8 quick points about how to invest in what you know. Number 1, stocks are not lottery tickets. It's not an instant way to wealth and prosperity. Number 2, you have plenty of time. And by not timing the market, but having time in the market and having an attitude of this too shall pass, according to Peter Lynch, you do not have to be near or close to an initial public offering or IPO. He gives the example of Walmart. And he said 10 years after Walmart went public, explosive growth kept happening, and you could multiply your initial investments. And sometimes big media splashes don't always last. Jeff Bezos, the founder of Amazon, was Time Magazine's Man of the Year. And then not long after that, the Amazon stock tanked, and it was down quite a bit. But we all know it came roaring back over the time. So you had time to get in and understand that, especially if you're using that in that stock, that company in commerce. Number 3, 10% corrections in the market happen at least every 2 years and sometimes more often. So volatility is a natural occurrence when buying risk assets. The key is to ride those out, stay in longer, and not panic. Number 4, the bigger types of corrections, the bear markets, where you might have 25% corrections or more, might average 1 in every 6 years. These create opportunity. And of course, you need cash to pounce on that opportunity. And I have a couple other videos that help explain that phenomenon. And we'll have links to that in the comments section. Number 5, a stock doesn't know that you actually own it. And more importantly, it doesn't care. But you're likely to care about the companies and the industry behind it because it's an area you know. And you're able to keep a level head as an investor. Number 6, there's always something to worry about. Owning good companies and even turnarounds. The economy keeps moving forward even with clouds of fear on the horizon. Peter Lynch and Warren Buffett have ideas to help us get through these conditions and profit. And we can get into these investment principles in other videos. And I've been to several Berkshire Hathaway meetings in Omaha, and I picked up this really cool, kind of stupid looking pillow. But this represents for me investment wisdom, and we can do additional video exploration of the investing principles of the greats. So a question for you, let me know what you use as investing principles or rules of thumbs, and you may have borrowed them from some of the great investors of the past. Number 7, in many cases and over the long term, as company profits go up, so does the share price and the value of the company. But you have to do research, and a lot of that research insight is in this book and those written about Mr. Buffett and Charlie Munger. Number 8, portfolio risk appears to diminish over time. So this is the idea, the longer you hold an asset, the risk and the volatility of holding that starts to smooth out over time as you ride out some of those downturns. And perhaps during those downturns, you're picking up more shares. Also, the longer you hold companies, in some cases, the fewer tax consequences you have from short-term trading and short-term thinking. Next, I have an amazing story of how I learned and had to unload one of my most profitable stock investments because I was getting ripped off. But first, don't forget to hit that subscribe and that like button. This helps move our content to more people. And what we offer here is free, non-conflicted, commercial-free, and very educational for folks. Now, back to my 10-bagger story. And by the way, the person that ripped me off on real estate got a 132-year prison sentence. But that's probably the subject of another video. But essentially, I had to sell the 10-bagger initial public offering investment of Chipotle that I had. And we need to bring the bag out for this. 10-bagger, yeah, right. So to pay off some accumulated debt from real estate fraud. Now, the real estate situation worked out fine, everything was recovered, and I obviously learned a lot. But I thought I had missed out on the Chipotle investment. Part of my sadness was to have to sell that at that time to pay off that real estate debt. But because I thought the company was going to keep growing as they kept selling everything that they have in their stores. But as it turned out, later on, I started to rebuild a position in this stock. And here's why. They had a turnaround or an incident, and you may have remembered this in the media. Some of the Chipotle stores had illness breakouts regarding food handling procedures, which depressed the stock price. In essence, that stock, as a growth company, kind of became a turnaround situation, as Peter Lynch might call it. So I began buying larger amounts with more regularity. Again, I'm investing in what I know, and I've been following this company for a long time. So during that bad news, as the price of the stock went down, I bought more. I was also tracking the company very intently. I used to go to their shareholder meetings once a year that were located in a hotel 2 blocks from my office. And they would have them early in the day, even before my office opened. But these guys and gals were so cheap. I thought I could go have maybe a Chipotle breakfast. And I know they don't serve Chipotle for breakfast. But I didn't get a coupon. There was no breakfast. The room was small. I was sitting in a cramped room at their annual meeting, shoulder to shoulder with other men and women who were worth tens and tens of millions of dollars. The only thing I got free that day was a fresh perspective and understanding of the company and some uninspiring hotel coffee. And I didn't even like coffee. But anyway, it found out that the company over time, through these incidents, was not living up to its potential from a marketing or even an operations standpoint. And later the board hired new management from Yum Brands, a great leader from Taco Bell. But I was already positioned to get in on the upside of the new management. And now with this reconstituted investment position in the stock, it grew to a similar size in what I actually had to sell years prior to pay off that real estate debt. Now, sure, a lot of time passed, and the stock, as most stocks do, they don't go straight up. There were many ups and downs and a lot of flat periods. But I kept a close eye on that company, and it worked out. So let me pause here for a second. And you might be thinking, I'm not sure about this. What do I know that's so valuable? Well, 2 points. And you may have heard about these 2 books I'm going to mention. The first is StrengthsFinder. It's the concept of playing to or capitalizing on your strengths versus working on your weaknesses. And I actually knew a corporate executive who once told me, I think you should work on your weaknesses and your strengths will take care of themselves. Well, what are we talking about here? We're talking about your strengths, investing in what you know. And that concept flows from your strengths, your interests, your skills, and where you live and work. So here's an analogy that helps me think about strengths. I play drums. Now, I'm not that great, but in jazz and Latin jazz drumming, I'm not bad. It's a strength, and I've played and practiced thousands of hours. I have a weakness for violins. I don't have one. I've never played one, and this time I'm not interested in learning. But you get the idea. Violins for me is a weakness. So should I spend my time working on this weakness and the dozens of other musical instruments I have no clue on? It's more effective and with more confidence and enjoyment that I play to my strengths. In music, it's drums and percussion. Now we're going to have a link to the StrengthsFinder book and this other book called Mindset. And this is the concept of a growth mindset versus a fixed or scarcity mindset. It's being open to new possibilities. In other words, that our talents and abilities aren't fixed. They can be developed, exercised, and improved. And we'll have a link. So for investing in what you know, look at it with a growth and learning mindset. and play to your strengths and advantages because you have a lot of them. So now we turn to what to invest in. Now I've used both stocks and select sector investments to move to action on my local point of view and perspective and observation of stocks and companies that I know and follow. And remember, with companies, you have market risk and company risk because you're not really diversified. You're in kind of just one company. But you can diversify the other parts of your portfolio. Obviously, this is kind of that specialization focus area. You can buy on dips and over time using dollar cost averaging, regular investing, and you are buying more shares when the prices are lower over time. But let's say you see an industry or sector with possibilities, but your research is limited, and the company you know may not be the best performer, and you want company diversification in this sector category, and you can find that through sector investing or a sector index or even an actively managed fund that focuses on a sector. So you end up with a basket of companies, a basket of stocks. You still have the industry risk and the market risk, but you've tamped down the company risk because you're in multiple companies. We talk here at What's Next with Money about core and explore. And again, core are those other asset parts of your portfolio, and explore could be some of those that we're talking about now on investing what you know they're more specialized, niched, and nuanced. So I'm going to give you a little list that I have invested in or had investments in the last 10 years. And these are kind of some of those industry sectors. And I didn't have the time or the interest to pick companies within these. So I picked the sector and bought a basket of securities this way. And here are a few of those categories: water resources, robotics, energy, rare earth metals, AI, artificial intelligence, utilities, and real estate. Now, while these are concentration plays, they do have a little bit of diversification. And since many of them are exchange-traded funds, the costs are low. And some even have a global footprint, they're not just domestic stocks. So they complement my core equity asset allocations. And asset classes, let me just mention a few: domestic and international, emerging markets, global. Then there are styles of assets, value and growth, as well as size, small, mid-cap, large cap. We have a companion video called Asking the Question, Can Cash Be an Asset? And I cover more in that video on asset classes. So don't forget, we have also a Invest in What You Know Part 1 video we'll have a link for as well. So be sure to hit that subscribe and like button, and don't forget to share. And remember, new episodes of What's Next with Money are posted on Thursdays.